Morning, everybody. Welcome to this webinar on our dreaded Corona and SARS relief measures. Looks like we've got a nice big full house this morning, so lots of you are quite keen on understanding whether you actually qualify for any of SARS relief measures, and if so, how those calculations work and what sort of implications that'll have on payment dates, submission dates for returns, cash flow, etc. So you'll see, I'm going to be sending you the actual slide deck afterwards, and you will note that I've tried to compile it in quite a lot of detail. And that's pretty much so that after the webinar, you can use the slide deck as reference. So if there's anything that you may have not or that you may have missed or can't remember from the actual webinar, you are very welcome to revert back to the slide deck itself. And if there's still anything unsure, we've placed our contact details on the very last page, and we look forward to making contact with you and seeing how we can assist. So the SARS mechanisms that they've made available now after lockdown pretty much comprises of the employee tax incentive, or ETI. There's a 20% pay-as-you-earn deferral, and then there are the provisional and income tax deferrals. So we're going to start off with employee tax incentives, and you'll see that this specific relief is only valid from the 1st of April of this year until the 31st of July 2020. So in other words, the end of April payroll up until the end of July payroll. So let's quickly do a recap of what does our existing ETI program look like. And for those that may be unfamiliar with ETI, this is an incentive scheme initiated by government to encourage the employment of youth workers, and obviously to ensure that they are also upskilled in the process, and encourage employers to maybe rather invest in youngsters and upskill them in the process than to employ already qualified individuals. So the ETI program makes provision for an employer to claim ETI when the following two criteria is met. He or she is between the age of 18 and 29, and they must have a monthly remuneration, this is gross remuneration, of less than 6,500 Rand. So currently the maximum that we can claim as employers is 1,000 Rand per employee that qualifies for the first year, and then thereafter it's 500 Rand per month per employee. And we must always keep in mind that under the current legislation, ETI can only be claimed for the first 24 months of a qualifying employee's employment by an employer. So the proposed relief sees a small change made to that existing benefits. So they've increased the ETI that's claimable from 1,000 Rand in year one per employee to 1,500 Rand, and then thereafter the 500 Rand has been increased to 1,000 Rand in the second 12-month period. So you've got a cumulative 1,000 Rand over the 2 years that could be available to be claimed. They've also made amendments to the qualifying employee criteria, and this has now been amended to any 18 to 29-year-old employee whose previous ETI claims have already exceeded the 2 years, 24-month period. Those individuals for the next 4 months are now eligible to claim their 500 Rands. And then any person from the age of 30 to 65, which previously weren't eligible for ETI, are now actually included in the relief program as well. So let's quickly look at the requirements. Who will qualify for this? So this is not applicable to any new employer registrations after the 1st of March 2020. In other words, if you are a new company and only registered now with SARS, this unfortunately won't be applicable to you. Only employers that have been registered by 29 Feb 2020. An employer must not reduce the employee's tax payable. And this is quite important because you'll see later on in the slide deck, we've made mention of that fact as well. The fact that SARS levies understatement penalties if we are under declaring our actual payroll with the deduction of the ETI. So we have to still declare the gross payroll, allow the SARS system to calculate the ETI deductions so that we can arrive at the eligible net payroll in that specific month in. So we are not allowed to deduct the ETI before we submit the payroll. And then obviously any employers that are non-tax compliant, in other words, that have failed to submit any tax returns up to this date, or still has any outstanding tax debt due to SARS, will be automatically disqualified. So there is a stipulation on the SARS website that also reads that if you are currently non-compliant, you can bring your compliance up to date in this 4-month period and then at that stage apply, but it won't be applied retrospectively. So let's quickly have a look at an example. So employer A is a resident company in South Africa, has 10 workers earning 4,500 Rand per month each. And in terms of the new proposal, the employer may now claim 500 Rand per month for each employee, although the employer never enjoyed ETI benefits previously for these employees. So the outcome, there's an additional 5,000 Rand per month, which is the 10 employees times the 500 claim per month that can now be deducted off of the PAYE liability each month between April and July. And obviously this is under the understanding that the 10 employees that is used in this example are not the only employees that this company employs. That's why there is still a deduction that we can make off of the PAYE liability, because there are other staff members that earn in excess and for whom there are still PAYE deductions happening each month. And then in example 2, employer B, which is also a resident company, and remember, company here includes any self-employed individual or person as well. So employer B has 3 workers, employee A, B, and C. Employee A is an eligible ETI claim. Employee B, we've already claimed the full 2 years worth of ETI deductions a while ago. And then employee C is a 34-year-old that's never been able to qualify due to his or her age. And each employee earns 4.5 per month, same as in example 1. So what that would mean, so employer B will be able to now retain the following amounts. So employee A is now a claim of 1,500 Rand per month, where it previously was only 1,000, and keeping in mind that it's a individual for which we can actually claim ETI in year 1. So that's why the amendment kicks in on employee A. Employee B, we could previously claim nothing, and now we can claim 500 Rand. Why is that? Because employee B has exhausted his or her ETI claims. So we've already claimed a full 2 years, but with the amendments, we are now allowed for the following 4 months to claim their 500 Rand per month as well. And then employee C, also previously no claim, can now claim 500, and that is because he or she was excluded due to age, now being included. So now there's an additional 2.5 that we can claim until the 31st of July. So the monthly wage bill of 13.5 means that there's a 19% retention that can now be deducted each month. So because in this instance, there are no other employees, like in example 1, there won't be any PAYE submission because both A, B, and C earn below the tax threshold. So that would mean that this amount would likely now be claimed as a reimbursement from SARS. So you may also recall seeing in the news that one of the stipulations there read that currently reimbursements from SARS only gets issued every 6 months, and they are now trying to speed that up with reimbursements being paid out on a monthly basis. An important fact to just keep in mind here is that your ETI claim will be influenced by any UIF claims that you submit as part of this relief process. And why the two go hand in hand is if you've submitted an application to the UIF fund for relief because you had to physically shut down and let your staff go home for 4 months or however long, that means that the UIF office, through that relief process, will actually pay your staff directly. Now, what that means is you as an employer, you won't have any payroll for that month. So if I don't have any payroll, I can't submit ETI. There are certain exemptions to that, or variants rather, and that is in the case where, let's say you've sent your staff home, and instead of their full salaries, you are still paying them 1/3 of their salaries. That means that the UIF office won't be able to pay them their full salaries because you as the employer still contribute to their remuneration, which means in that case, you'll still have payroll and there will still be an ETI prorated component on that payroll over and above the fact that you've actually claimed from UIF as well. So just keep that in mind. There are variants to the rule. So that brings us to employees tax, or PAYE. And you'll see this is also valid from the 1st of April till the 31st of July. So payrolls running on 30 April up to the end of July. And always just remember that we pay the PAYE over to SARS 7 days after month end. So this would be the 7 May payment up to the 7 August payment. What does the existing structure for PAYE look like? An employer must deduct the necessary employee's tax from an employee's salary each month. A return is due for submission within 7 days after closing off the month, with the respective taxes also being payable on or before the 7th of the month. So if a business day falls, or rather the 7th does not fall on a business day, i.e. a Saturday or Sunday public holiday, it's payable by the last business day prior to the 7th. So the proposed relief for this PAYE implementation is now allowing the employer to defer 20% of the total PAYE that was due for payment to SARS. So you can see that this is now from the 7th of May till the 7th of August for the July payroll. And then it's important to just keep in mind that this is only a deferral. It's not an exemption. So SARS does not discount our PAYE because we are now struggling. They are trying to alleviate any cash flow pressures by deferring 20%, which means we still have to pay it at some stage. So whether the cash is in the bank at the moment or not, you may want to still make use of your 20% deferral and then just put that 20% somewhere in an investment account and then pay that over to SARS when due. Or if it's really a case where the business is struggling right now and there's no money in the bank, then obviously the 20% deferral is welcome. Keeping in mind, we're going to have to settle that at some stage. How would that be paid over to SARS? Well, the relief we get over the next 4 months now accumulates, and that total value would then be payable in 6 equal installments on the August return up until the January return. So our payments would then be 7th September for August, all the way up until 7 Feb 2021 for the January return. And let's quickly look at an illustration on that. So I'm running my April, May, June, and July payrolls. These are my total PAYE liabilities. I am deferring 20%, which cumulatively over the 4 months comes to 120,000 Rand. My 80% payables, those are still submitted and paid over to SARS on or before the due date. Otherwise, there's penalties on that. But the 120,000 now, remember, becomes payable to SARS in 6 equal monthly installments. That gets incorporated into our August, September, October, November, December, and January 2021 returns, with an equal distribution of 20,000 Rand per month on those respective due dates. So the way that we've instructed our accountants to implement this measure into the books is we typically see, and you'll also note this from your management accounts at the end of the month, or rather at the end of April, is you'll see a control account. So there's now going to be a COVID-19 PAYE control account so that we can keep track of all the deferred payments, and then we'll distribute that on a monthly basis in equal proportion till on the Feb management accounts, you'll see that control account becomes 0. Income and provisional tax. So this is also valid from the 1st of April, but Treasury and Government, or Treasury rather, and SARS has both advocated for this to be extended for a 12-month period until the 31st of March next year. And I know provisional tax and income tax is usually a interesting topic, so I just always like to remind clients that it's exactly the same type of tax. The one is just a provisional measure towards the final income tax at the end of the year. So for that purpose, they will be discussed together. So let's have an overview of what the existing structure looks like. So in my financial year, a provisional taxpayer must make a calculation, and this is always an estimate, and submit a return of a provisional tax payment to SARS. And this is only in the case where there is a taxable profit in the company. So if your business is running at a loss, there's a return submitted, but there's no payment to be made. So you can't defer anything that you are not paying in the first place. So that first payment, which is 50% of the total estimated liability. So when you make your estimate in bullet point number 1, it's an estimate for the full 12 months. Now, as an example, if you've got a Feb year end, your first payment must be made within 6 months after the start of your financial year, which you guys all know by now, is the 31st of August of each year. And then we must pay over 50% of the total estimated liability. The remainder, the second payment, is then due by 28 Feb, and SARS does not allow us or let me rather rephrase, SARS allows us 20% leeway without incurring any understatement penalty. So if we do our forecast and we calculate our tax, that estimate may not differ from the final calculation with more than 20%. Otherwise, we've underdeclared and there is a penalty and interest for that. If you submit your return on the 28th of Feb and the 31st of August respectively, but you only make the payment a few days later, there is going to still be a late payment penalty, and interest will accrue on a daily basis. So it's important that when you file the return, payment needs to accompany that return on the same day. So penalties, there is a 10% penalty for late payment, there is a penalty for underpayment, and there is interest that accrues on any unpaid portions of the provisional tax liability. The new proposal they've announced is now a deferral of a portion of the payment on the first and second provisional tax liabilities without SARS imposing any administrative penalties or interest for the late payment of the deferred amount. So if I hold back a portion of my provisional tax money and not pay that over to SARS as per this proposal, under the old structure, that would have immediately been subjected to penalties and interest until such a time where I've settled the amount. And what SARS is now saying is I'm allowing you to defer the amount without imposing any of those late payment penalties and interest. So the first provisional tax payment that is now due from the 1st of April 2020 till the 30th of September 2020 will be based on only 15% of the estimated tax liability instead of the previous 50%, whilst the second provisional tax payment from the 1st of April till the 31st of March 2021 will be based on 65% of the total tax liability. So at the end of the day, there's a 35% that we've managed to defer between the two submissions. So provisional taxpayers with deferred payments will be required to pay the full tax liability when making the third provisional tax payment in order to avoid any interest charges. So who qualifies? Company, first of all, obviously must be tax compliant. That means no outstanding returns and no outstanding debt. So tax relief is also only available to small businesses. In other words, annual turnover of less than 50 million. And if you've got any outstanding returns or outstanding debt, you are disqualified, except for if you've got an existing payment arrangement for any backdated taxes that you are servicing each month. You would, from that perspective, still be eligible to claim. So let's look at an example. So company A is again a resident company with a financial year end of 30 June 2020. So obviously its first submission was already due by the 31st of December last year, and it would have already paid 50% of its estimated total tax liability, in this example 3 million, over by the end of December. Its second provisional tax return is now due on its financial year end, 30 June 2020, and this is during the period of the temporary relief measure, as per this slide over here, where our dates are indicated. So instead of paying a further 1.5 million, which is the 50% on the 3 million estimate, based on current legislation, it now only needs to pay 450,000, which is 15% of the 3 million, so that the cumulative total of the first and second provisional tax payments is 65% of the estimated total tax liability, as opposed to 100%. So this will provide company A with just over $1 million in cash flow benefit during this temporary relief period. So to just quickly revert back to this 50% and 15%, you might have picked up that it's slightly different to the initial explanation over here, where the first one is subjected to 50% and the second one is based on a total of 65%. So 15 plus 50 on the second gives me the 65. So in this scenario, because our first submission was pre the relief period, and we are by law already required to have submitted and paid 50% of my estimation, to balance out to the 65%, I am only required to now submit 15% on the second one, which is slightly contradictory to the actual initial example. So proper cash flow planning. It's important to note that from this example, the relief obviously on company A over here that has a June year end, he has to submit his first provisional tax return by 30 June and the second one by 31 December 2019. Now, this $1 million that has now been deferred has to be paid by the 31st of December 2020, which in this instance, unfortunately also coincides with the first submission for its 2021 financial year. So if this company remains profitable during this shutdown period, on that day, they will actually have to settle the debt on 2 financial years worth of taxes. So it may be advisable in that case, if the cash flow has been accumulated and is available, that we perhaps settle the accumulated relief of R1 million prior to us submitting and having to pay the 2021's first provisional tax return on 31st of December as well, just to alleviate some of our cash flow pressures at that stage. Let's look at another example. So we've got company B as a resident, also in this case has a 28 Feb 2021 financial year end, which most of you on the call would have. Its first provisional tax payment will coincide with the shutdown period, which is now 31st of August. And you'll recall that it's stipulated over here that our second one is due, or is actually relieved from the 1st of April till the 30th of September 2020. So in this example, 31st of September actually falls within this relief period. So it is given that an estimated total tax liability for the year will amount to 800,000. So therefore, the first provisional tax payment that's due by the 31st of August this year will be 120,000. So keeping in mind, unlike the previous example, we are now making our first and second payments, where the first one has already been included in our relief period. So now we are subjected to the actual 15% that they initially indicated. So the 15% of the 800,000 will be 120,000 instead of 50% of the 800,000, which would have been 400,000. That allows us a temporary relief of 280,000 that stays behind in the bank account. Then as a further relief measure, only 50% of the estimated tax liability will be due now by 28 Feb 2021, which still falls within our extended relief period. So the cumulative total tax again amounts to 65% submitted by the end of Feb next year. So the remaining balance of 280,000, or the 35% of the total tax total tax estimation of 800,000, will then be due by 30 September 2021 in order to avoid interest. And that's obviously the cutoff for your third provisional tax payment. Now, again, same rules apply. 31st of August 2021, that's actually the submission date of my first provisional tax run for the 2022 tax year. And a month later, we have to settle the tax for 2021 that's been accumulated. So again, from a cash flow perspective, it's advisable to just keep track of this and build this into your cash flow forecast so that you've got absolute visibility of these two numbers so that we can prepare the cash flow in advance. It's important to remember here that SARS has not extended the deadline for any submissions of any returns. So in other words, the due dates remain fixed and we still have to submit the returns on those days. If there are any taxes payable within this framework, the correct amount has to be paid over as well. Otherwise, there will be understatement penalties. So in a nutshell, that is where we are in terms of SARS relief. If there's any questions that originate from this webinar that you would like to discuss with us or get more insights into, please do not hesitate to reach out to us and make contact. We are very happy to help. So at this stage, whether you were a client or not, we just trying to reach out to as many people as possible and see how we can assist them getting on top of this situation at the moment. So to just quickly recap, we've got ETI, we've got PAYE deferral, we have got our provisional tax deferral, and we've got our income tax deferral. Important factors to keep in mind on our ETI is that depending on your payroll, if there's a specific portion of the payroll that you'll keep paying your staff members during this period, that'll influence your UIF claim, and it'll per implication also prorated influence the ETI eligibility. Your PAYE deferral, important fact to remember there, is that over the next 4 months, the accumulated relief will be distributed into 6 equal amounts and will be payable from 7 September till 7 February 2021. And then your provisional and income tax deferrals, it's important to note there that you are working on a cumulative 65% of your total taxable income, which needs to be settled within the first and second payment, and then your deferred amounts has to be paid over to SARS before the end of your third provisional tax submission, before any interest starts accumulating. Guys, so good luck. Hope you found this informative, and we look forward to catching up with you soon. Stay safe and all the best. Bye.